Most new investors don't lose money because the market is rigged. They lose it in the first 90 days because they make the same predictable mistakes. Overconfidence, impatience, and chasing hype wipe out beginners faster than any crash ever could. I've watched it happen over and over again, and once you understand why it happens, you can avoid it completely. Before I break it down, make sure you like this video, subscribe, and turn on notifications, because learning this early can save you years of costly mistakes. In this video, I'm breaking down why most new investors lose money in their first 90 days. The psychological traps, bad habits, and unrealistic expectations that sabotage beginners before they ever get momentum. If you're new to investing or thinking about starting, this isn't about fear. It's about clarity. Because the first 90 days don't determine your success, unless you let them. Jumping in without a plan. The biggest mistake new investors make is treating the stock market like a casino. They hear about a hot stock from a friend, see a trending ticker on social media, and immediately throw money at it without understanding what they're buying. This is emotional investing at its worst. Without a clear investment strategy, you're essentially gambling. Successful investing requires you to define your goals first. Are you investing for retirement in 30 years or trying to build wealth over the next 5 years? Your timeline completely changes what you should buy. New investors often skip this crucial step and end up panic selling when things don't go their way immediately. A solid plan includes knowing how much you can afford to lose, what types of investments match your risk tolerance, and having clear entry and exit strategies. Without this foundation, you're setting yourself up for costly mistakes that could have been easily avoided. Following the hype and FOMO. Fear of missing out is responsible for more investment losses than almost anything else. When you see headlines about stocks doubling overnight or your coworker bragging about their returns, it triggers something powerful in your brain. You don't want to be left behind, so you jump into investments at their peak, right when everyone else is already selling. This is how bubbles work, and new investors fall for it every single time. The problem with chasing hype is that by the time you hear about an opportunity, the smart money has already moved on. You're buying at inflated prices, and when reality sets in, you're left holding the bag. Social media has made this worse. Influencers and online communities pump up certain stocks, creating artificial excitement. New investors see these posts and think they've discovered a secret, but they're actually walking into a trap. The key is learning to ignore the noise and focus on fundamental analysis. Ask yourself if you would buy this investment if nobody was talking about it. If the answer is no, you're probably making an emotional decision that will cost you money. Ignoring risk management. New investors often put all their money into one or two investments, thinking they've found the next big winner. This is incredibly dangerous. When you don't diversify, a single bad investment can wipe out your entire portfolio. Risk management isn't sexy, but it's what separates investors who survive from those who crash and burn. The basic principle is simple. Never put all your eggs in one basket. Spread your money across different sectors, asset types, and even geographic regions. This way, if one investment fails, your others can cushion the blow. Another critical aspect of risk management is position sizing. Just because you have $10,000 doesn't mean you should invest all of it immediately. Smart investors start small, learn from their mistakes, and gradually increase their positions as they gain experience. They also use stop-loss orders to automatically sell if an investment drops below a certain price, limiting their potential losses. New investors skip these protective measures because they're focused on potential gains, not potential losses. This overconfidence leads them to take risks they can't afford, and when the market turns against them, they have no safety net. Reacting emotionally to market swings. The stock market goes up and down, that's just how it works. But new investors panic at the first sign of trouble. They see their portfolio drop by 10% and immediately sell everything, locking in their losses. Then, when the market recovers, they're sitting on the sidelines watching others profit. This emotional roller coaster destroys wealth. The market will test your patience and your nerves. Successful investors understand that short-term volatility is normal and expected. They don't check their portfolios every hour or make rash decisions based on a single day's movement. Instead, they focus on the long-term trend and stick to their strategy. One bad week or even one bad month means nothing in the context of years or decades. New investors haven't developed this emotional discipline yet. They react to fear and greed instead of logic and data. When everyone else is panicking and selling, that's often the best time to buy. When everyone's euphoric and buying, that's when you should be cautious. Learning to control your emotions and act rationally during market turbulence is one of the most valuable skills you can develop as an investor. Not doing proper research. Would you buy a car without checking under the hood? Of course not. Yet new investors regularly throw thousands of dollars at stocks they know nothing about. They don't read financial statements, don't understand the business model, and can't explain what the company actually does. This is financial suicide. Before you invest in anything, you need to do your homework. Understand the company's revenue streams, profit margins, debt levels, and competitive advantages. Look at the management team and their track record. Research the industry trends and figure out if this company has a sustainable future. This might sound boring compared to just buying what's trending, but this research is what protects your money. Many new investors rely entirely on tips from others or simplified analyses from apps and websites. While these can be starting points, they shouldn't be your only source of information. Overtrading and chasing quick profits. New investors often believe that more trades equal more profits. They constantly buy and sell, trying to time every market move and capture every opportunity. In reality, overtrading is one of the fastest ways to destroy your wealth. Every trade costs you money in fees and commissions, even if they seem small. More importantly, frequent trading increases your chances of making emotional mistakes and timing the market wrong. Studies consistently show that the most successful investors are those who buy quality investments and hold them for years, not those who trade constantly. Day trading and short-term speculation might look exciting, but the statistics don't lie. The vast majority of active traders lose money over time. New investors underestimate how difficult it is to consistently predict short-term price movements. They see a few winners sharing their success stories online and think they can do the same, ignoring the countless losers who stay silent. The market doesn't punish beginners for starting. It punishes them for rushing. Once I stopped trying to win fast and started focusing on learning, discipline, and patience, everything changed. If you're early in your investing journey, slow down. The goal isn't to get rich in 90 days. It's to still be winning years from now. Like the video, subscribe, and share it with someone who's new to investing. Until next time, stay disciplined, stay patient, and play the long game.